Hi everybody, this is Ellman, the blue collar investor, with today's option selling question of the day. Today's question comes from Penny, who is new to option selling and is just beginning her career to become CEO of her own money. Alan, I am a new member and have a question about option selection. Once we choose the stocks from your weekly list, can you provide some guidance as to how to decide the best options to choose? I know it can vary from one investor to another, but some general framework will be very helpful. Thank you, and it's signed, Penny. Well, Penny, you have come across a very important subject, option selection, which is the second of the 3 required skills. The other 2 are stock selection and position management. So let's get into what our choices are relating to option selection and see if we can give you a framework that'll launch your career in a positive way. Now, as it relates to options, there are 2 main categories that we have to decide on. The first one is how far out to go relating to our option contract. Now, in the BCI community, we do have members that are using weekly options, and those expire every Friday at 4 p.m. Eastern Time. Now, most of our members, myself included, use monthly options. Monthly options expire on the 3rd Friday of the month, also at 4 p.m. Eastern Time. So for purposes of this video, we're going to be showing monthly returns. Actually, we're going to expand it an extra week because I'm making this video a week before the January contracts expire. So we're going to go out 5 weeks to the expiration of the February contracts. But generally speaking, I like to use 1-month expirations. Now, relating to the second category with option selection, we must decide on the moneyness of the option. And what that means is the relationship of the strike price of that option to the current market value of the stock. And there are 3 main categories. The first is the in-the-money strike, and that's where the option strike price is lower than current market value. So we buy a stock for 32 and agree to sell it for 30. Now, that's the most conservative, or I would say defensive, way to approach covered call writing, because we get additional downside protection at the expense of no possibility of additional share appreciation. So there's a trade-off here. But if we're looking for a more defensive position, then we're going to go with the in-the-money strike. We also have the at-the-money strike, buy a stock for 30 and agree to sell it for 30. And that's the one that's going to generate the highest initial time value return, but give us no downside protection of the initial time value profit and no possibility of share appreciation. So we get the highest initial time value return. Now, of course, there's always a break even, but when I say downside protection, I'm talking about of the initial time value profit. Only the in-the-money strike will give us downside protection. Finally, the most popular type of option related to moneyness is the out-of-the-money strike. We buy a stock at 28, agree to sell it for 30. And the reason it's so popular because we have an opportunity for 2 income streams in the same month with the same investment. One from option premium and the other from share appreciation from current market value up to the out-of-the-money strike. So those are the choices that we have as it relates to the option. So how do we know what to decide upon? Let's say we've decided on weeklies or monthlies, and now we're deciding on the moneyness of the option. How do we make that decision? Well, I would say that there are 4 parameters that we should be using. The first one, and a very important one, is the overall market assessment. If we're bullish on the overall market, we're more likely to take a more aggressive position in the form of an out-of-the-money strike. If we're bearish on the market or it's a volatile market, we then may take a more defensive position and go with the in-the-money strike. What about the stock itself? If we look at the price chart of the stock, are all the indicators that we use bullish? Or are they mixed? Are there some good and some bad? If they're all negative, of course, we wouldn't even use that stock. But if they're all bullish, we might favor a more aggressive approach, the out-of-the-money strike. And if we're more concerned with a mixed technical chart, we might favor the in-the-money strike. Next, personal risk tolerance. Some of us may be more aggressive and be willing to undertake a little more risk with the possibility of greater returns. Others may sleep better at night if they have more defensive positions and move with the in-the-money strikes. And finally, no matter what strike we select, in the money, out of the money, at the money, we must get our initial time value return goal. So in my case, it's 2 to 4%. I'll go up to 6% in a strong bull market. And so whether I do out of the money or in the money, I must get close to or within that range of 2 to 4%. So those are the parameters that we use. Now, I'm creating this video on January 10th, 2020. Let's have a look at the chart of the S&P 500 and the VIX, which is the CBOE Volatility Index. You know, projecting the volatility of the market over the next 30 days. Some people refer to this as the investor fear gauge. Now, the thing about looking at the S&P 500 and the VIX is that they are usually inversely related. So a bullish chart pattern would show an increasing S&P 500 and a declining VIX, or VIX trending sideways at a low level. Now, the price chart that you see here for the S&P 500 and the VIX, you could see that the S&P 500 over the past 6 months is actually up a robust 10%. And the VIX has been down nearly 9%. So overall, I would consider this a bullish overall market chart pattern. I also look at Eric Wish's GMI index, which is in my material, and I look at the IBD market assessment. So those are the things I look at. I also read all the monthly and weekly economic reports, but this chart is very, very important in giving you an overview as to market assessment. For purposes of this video, let's assume we're bullish on the market at this point in time. Now, what I did was I selected 2 stocks from our premium watch list as of January 10th, 2020, one with a all bullish chart pattern and one with mixed technicals. So we're going to start with Boot Barn, ticker BOOT, which had a bullish chart pattern. If you take a look at the screenshot, you'll see that at the top right, the moving averages are trending upward, with the shorter term 20-day exponential moving average higher than the 100-day exponential moving average. That's a bullish pattern. So far, so good. Then if we go to the circled area in the middle of the chart, you see the MACD histogram, those blue bars, ascending and above zero, also bullish. And the circle at the bottom right of the screenshot is the stochastic oscillator, another momentum indicator, which you could see recently has been ascending, is now above the 80th percentile. Some people call that overbought, but we've seen stocks holding in that overbought position for months and months and months. So generally, we have a bullish chart pattern, which means we're going to favor out of the money strikes. So let's have a look at the options chain of Boot as of 110, and these are 5-week returns. With the stock trading at $45.83, let's look at the $50 strike. You can see it on the bottom row there, and the bid price was $1.60. Okay, let's feed that information into the multiple tab of the Ellman calculator. You can see the blue cells on the left are filled in. 45.83, the 50 strike generated 160. Now the white cells become populated, and you could see the ROE, or return on the option, for the $160 per contract premium was a 3.5% 5-week return within our range. An upside potential is humongous, 9.1%, if the price of the stock moves from 45.83 up to the 50 strike by contract expiration. So there's an opportunity here for a 12.6% 5-week return. Again, we have all bullish chart technicals and an overall bullish market assessment. Now let's have a look at Teleflex Inc., ticker TFX, which had a mixed chart pattern. So if you look at the top right, you can see those exponential moving averages again, ascending and bullish. So far so good. But below that, we see the MACD histogram in the middle, circled in black, below zero slightly, and the stochastic oscillator recently dipping below the 80th percentile, which is a red flag. So I would call this a mixed chart. With a mixed chart, even though the overall market is bullish, I may favor in the money strikes. Now, if we're selling multiple contracts and we have a mixed chart like this in a bullish overall market environment, there's no law that says we have to do all, let's say we're doing 5 contracts. There's no law that says we have to do all 5 in the money. We could do 2 out of the money and 3 in the money, or 1 and 4. And if it's a very bullish chart in a very bullish market, we may go all 5 out of the money, or 4 out of the money and 1 in the money. So we can mix and match depending on what's going on today in the market. So we would favor it in the money strike, let's say. This is a very expensive stock, 378.70. We're going to look at the 370 strike, which generated 1590. You can see here, and then feed that into the Ellman calculator. And you can see here that the ROE, or return on our option, is pretty close to the 2% lower part of our range, 1.9. And we have a 2.3% downside protection. So what that means is we are guaranteed a 1.9% 5-week return as long as share value does not decline by more than 2.3% by contract expiration. Just getting a little bit of an insurance policy to the downside, since the chart technicals were mixed rather than all bullish. Let's summarize. Option selection is based on several factors: overall market assessment, the price chart of the stock, what our personal risk tolerance is, and of course, the initial time value return goal range. I mean, we have to have our goals set before we enter a trade. Otherwise, how would we know whether we could be successful if the trade isn't set up based on what our goal is? Now, if we're bullish, we would favor at the money and out of the money strikes that meet our goal. In my case, again, 2 to 4%. In a defensive situation, we would favor in the money strikes that also meet our goal. So the time value must meet our goal either way, whether we're going in the money or out of the money. All right, so there you have it. That pretty much covers all bases. I just want to leave by first saying to all of our premium members that only you, our premium members, have access to the entire library of Ask Alan videos, now 171. We add one new one every single month. So all you have to do is go to the member site, log in, scroll down on the left side, and you'll see where the red arrow is on the top, the Ask Alan videos. You'll see the first 10, and then the arrow at the bottom shows how you can access the remaining Ask Alan videos. So right now, 171 of them, lots and lots of information based on some great questions from our BCI community. So Penny, thank you so much for asking a critical question related to the second of the 3 required skills. And of course, thanks to everybody out there for taking the time to watch this video. I hope you enjoyed it, and I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.